Good morning, everybody. Thank you for coming to this live coverage. I am Mauricio Carrillo, welcoming you from Florida, the Space Coast in the United States. And with me, there are the only and one Yohay Elam, connecting from Barcelona. He's the founder of Forex Crunch and especially the chief editor. Hi, Yohay, how are you?
I'm doing well. Looking forward to see what Draghi will bring us today if he moves the euro. So we'll have the rate decision in 2 minutes, right?
Yeah, in 2 minutes. We are expecting no changes. And what we are expecting today, let's make that I don't know anything about the ECB, and I am asking you what is going on today.
Well, yeah, the bottom line is no changes expected. We'll have that decision in just about 2 minutes, 1 minute. So the interest rate, mainly lending rate, is expected to remain at 0%. The deposit rate to remain at minus 40 basis points, minus 0.40%. And the QE program, which was reduced from 80 billion a month up to the end of March and 60 billion from the beginning of April, will remain at 60 billion and will run until the end of the year. No new announcements on policy are expected now. This is a meeting that does not consist of new forecasts. So the ECB meets 8 times a year. 4 meetings in March, June, September, and December consist of new forecasts. And so those are the more important ones. And today we have sort of the intermediate one, the less important one, but Draghi always moves markets.
Thank you, Yohay. So we are not expecting too much information today. Just people are expecting like a dovish ECB with no rate expectation and not changing any forecast because we don't have a forecast today, right?
The ECB is usually dovish, but I'm not sure they'll be dovish this time. Let's just cover the actual decision and make sure that it's really unchanged, and then I can repeat my preview for the ECB for the Draghi show, the main part. So we have the decision in a few seconds. No change, as expected, no change. Main lending rate is left at 0%, deposit rate minus 40. And looking at the euro-dollar chart, let's share the screen. Hardly see any change, right?
Yeah, no change. Especially, I am checking the euro-dollar true range that we have in the website, and in the first 15 minutes, there is not too many volatility after the ECB rate decision. The real movement comes like 30 minutes after the decision, on 1 hour after the decision, especially when Mario Draghi is just talking, right?
Exactly, and we'll have him speaking about at 12:30 GMT in 45 minutes. But even before he begins talking, we see some kind of volatility. I do see euro-dollar slipping a bit. Just before the decision, we did have some news from France, and when France plays a key role here, we learned from a new opinion way poll that Macron's advantage is slipping just a bit. So it's sort of eroding from, it was 61% against 39%, then fell to 60-40, and today it's 59-41. I'm talking about one specific poll, the opinion way poll. We have other polls, daily polls by IFOP and Delabe that are published later in the afternoon. So that might be the reason for the current slip. But anyway, it's a minimal slip. Macron is still expected to win.
So we can say that we will have a Trump scenario with the euro-dollar now with the French election. Before with Trump, it was like if Trump says something on any poll say that Trump is going to win, we will have a dollar going up or something like that. Right now, we'll expect that with a poll that say that Macron is going to win, so euro up. If not, if the race is tight, just euro down, right?
Yeah, and more specifically, you can argue that a Republican and the United States, Trump on one hand is Republican Party, which is more pro-market, and markets like that. On the other hand, anti-trade, so it was a bit more confusing, I think, with this runoff in France between Macron and Le Pen, things are clear. You have, and then when Macron is centrist, pro-market, pro-European, his short political experience as an economy minister, he tried to do some pro-market reforms. On the other hand, you have Marine Le Pen, not only racist, but more importantly for markets, also anti-Europe, wants a referendum on France's membership in the Eurozone and maybe perhaps in the European Union, much more protectionist. So it's really, they couldn't be more different. And also in the context of today, for the ECB, if Marine Le Pen becomes president, it has low chances. It's an existential threat to the ECB, because if France eventually leaves the Eurozone, there's no euro. It's hard to see a common currency without France, one of the founding members, one of the biggest countries.
But we all expected the same with Donald Trump. You know, and everybody was saying, no, Donald Trump will never become president.
Yeah, there are a few differences here. First of all, French polls were amazingly correct. So they were very steady. They showed very small different changes. And eventually, they figured out the first 5 places. They showed Macron first, Le Pen second, Fillon third, Mélenchon fourth, and Hamon fifth. And exit polls on the night of the elections were amazingly correct as well. So from 8 p.m. local time on Sunday until you had the final results the morning after, hardly anything changed from the exit polls to the full real results. So that's one big difference. Another difference is if we look at the past, most French people came out to vote against Marine Le Pen's father, Jean-Marie Le Pen, in 2002. And the third thing, if you look at Brexit, if you look at Trump, Clinton, these were very close. Maybe not too close to call, but very close. This time, even 59 against 41, it's quite a difference. I don't think it'll end with such a big gap, but Macron still has much higher chances to win.
Okay, so we can say that the French make better polls than the Americans in that way. Okay, let's move to charts. So we have the euro dollar here. This is coming down from, let me see, it's coming down from 0.0920. He's down. What do you expect from the euro dollar?
Well, it all depends on Draghi. If I look at my charts, we'll talk a bit about the charts, the technicals. So all in all, the bigger picture that I see is that euro dollar is trading in an uptrend channel. So we have higher lows from the beginning of the year, January, March, and more recently in April. We've seen higher lows. We've also seen higher highs, and the trend remains to the upside. So we reached a 5-month high on the outcome of the French elections. If we zoom in to the hourly chart, for example, here's the huge weekend gap on the French elections on Sunday. Then we had some consolidation support. I see at 108.30. Then also at 108.70. 109.05 was the previous 2017 high, and then 109.60. So now we're basically in the middle of this new range and awaiting Draghi. So it all depends on what he says.
Well, but technically, you know, the indicator are pointing to the downside. So do you expect a test of the, yeah, you know, let me check where it is. Yeah, the yesterday lows is 108.60. Do you expect any test there, or is this like the line on the sand or not?
No, I would say the line in the sand is 108.30, which was also the previous 2017 high, and also a low level seen earlier this week, and sort of the profit taking after the French elections. Let me show you this previous. Yeah, here we are. 108.30 was the high level seen back in February. Okay, so that's for me a very, very strong line, 108.30. And to the top side, I would say the high seen this week, 109.50. It's a level to watch. So we're closer now to the upside than to the down. No, we're basically bang in the middle. This 120 pip range, we're in the middle. So it all depends on Draghi and what he says. Yeah. So one thing I've seen now is a headline is that ECB did say in its initial statement that QE can be increased in size and duration if the economic outlook worsens. It can be pushed beyond December 2015. December 2017.
Yeah.
But this is not. I mean, they always leave all the options open, so I don't see it as extremely dovish. Not yet. I think the reaction in euro dollar is quite minimal as well.
Okay, and let's move to the pound. You know, if the pound is trading at, let me check. I have some problem here. Okay, it's trading in high from September the last year. So yeah. What do you think about what is going on with the pound dollar?
Well, technically we had
Yeah, go ahead. No, go ahead.
Well, this morning we had sort of a false break above the previous high. So the bigger story in pound dollar is that since the announcement by Prime Minister Theresa May of an early election on June 8th, we had this big jump here on on cable on pound dollar, reached a high of 109.05, okay, and which is the highest level, as you mentioned, since September. Then we had some consolidation, and now we had another move to the upside. So far, it's a false break. So far, we had a sneak peek above this level, reached 129.15, 16, and now we're back down. Currently, these moves by the pound are driven by the US dollar, the weakness of the US dollar, because of Trump's tax plan, which lacked in detail. If we do have further moves to the upside, I would point out to 130. Above 130, we have 130.50. These were levels last seen when the pound was trading on higher ground in the summer last year, and then 131.30. To the downside, I'm still looking at the initial post-Brexit low of 127.90, but we have much stronger support at 127 and 126.15.
So you say that if the pound break up the 128 or 129, that level, that strong resistance, we will return to the range that we were trading in the past summer. No? Go.
After Brexit, we had this relatively wide range between 128 to 135, and then in the autumn and the fall, we had the flash crash and additional falls. You dropped below 120, and since then it's been a lower range until this announcement about the election, in which we've seen the pound go higher. So the big test, of course, for the pound is tomorrow is the GDP release in the UK at 8:30 GMT. I think we'll finally see some kind of negative data coming out of the UK. Finally, Brexit is going to bite after we had two excellent quarters following the EU referendum, Q3 and Q4 2016, which still saw very strong growth. But I think now higher inflation, uncertainty is eating into consumption and growth.
Okay, thank you for your take on the pound. And let's check for the yen, the Japanese yen. We are in the middle of some kind of action from the BOJ, right?
Yeah, we had the Bank of Japan this morning. They didn't make any changes, repeating their mantra that they'll fight deflation. What's going on more in the yen is related to the French election. So we had this risk-off sentiment before the elections, and we had more demand for the safe haven Japanese yen, had the pair falling all the way to 108.10. And then, similar to the weekend gap we had in favor of the euro, we had a weekend gap against the yen, no need for safe haven and a jump. And this sort of risk-on sentiment is favorable for the yen. We almost reached, had this false break above the previous triple bottom at 111.60. last night when it was excitement about Trump's tax plan, but we had a retreat from there. I still see 111.60 as resistance, further resistance 112 and 113, support still at the round number of 110, and much lower support at 108.10.
Going to Japan, Japan has never come back from his crisis in the 90s. Do you how the economy is doing there, and do you expect if they will ever come back? Like as the big country they used to be.
Well, we'll hear more from Valeria that has just been to Japan.
Yeah.
But as far
I was in Japan in the last 2 years, and it was an amazing country with that, hard-working people, but not that dynamic economy. So they have some problems with innovation, and people are too strict, and the companies are too strict to change. So maybe that's a reason. So, but in terms of economy, the Abenomics are doing something a strong effect in the economy or not?
I think it is helping. I think countries out of the deflation zone, but so are other places in the world. I mean, China also had producer price deflation, and now they're back to inflation. Here in the Eurozone, where I am, we're seeing prices rising, especially here in Spain after a long downfall. So it's not only Abe, and as you said, it's still a very rich, very developed country. So innovation is lacking, growth is lacking, but they're still very rich, and the unemployment rate is very low. So I don't see Japan as a country in trouble. Maybe Japanese companies are not doing so well. I mean, stock market, but the Japanese government had a goal of reaching, Bank of Japan, of 2% inflation, core inflation. It seems very hard that they'll do that without a material change, as you mentioned, innovation, getting more women to the workforce, accepting immigration from outside if they want to see really strong growth, and also, inflation. I guess they don't want to see inflation for the sake of inflation. They want to see people getting out of this deflationary mindset that they expect prices to fall, so they don't buy, and this causes less consumption and more price falls, and etc. Yeah.
Okay, thank you, Yohay. So in terms of chart, we will see where there is an uptrend right now coming. And do you expect the dollar Japanese yen going above 112 or reaching new highs?
A lot depends on tomorrow's GDP numbers from the United States. We'll have that covered for you as well. I see again 111.60 still as strong resistance, but Japanese yen moves more on, first of all, safe haven flows, and secondly on what happens in the United States. So the announcement about taxes was a bit disappointing. It was a one-page statement. We're not sure if it'll pass Congress. We're not sure what kind of deficit it will trigger. So that was a setback. And tomorrow's GDP, if it's above 2%, I guess we'll see dollar yen moving higher, but nothing is guaranteed. And according to the data we have so far from Q1 in the United States, it doesn't look too good. We'll have the durable goods orders just as we begin the press conference.
Okay, thank you. So guys, we are at noon GMT. We are covering the ECB rate decision, and we will cover Mario Draghi presser. So let's move back to Mario Draghi. So do you have a presentation about what we can expect from Mario Draghi today? Yeah, just go ahead.
Yeah, it's from my morning show yesterday, and I invite you all to join every Wednesday at 7 GMT. Anyway, it's not going to be long. This is Mario Draghi. You're going to see him soon all over your screens. A bit of background. Back in March, that was a more important meeting with new forecasts. The European Central Bank removed the statement, the phrase in its statement about using all instruments. Okay, and Draghi was asked about it in the press conference. they said we don't have anymore a sense of urgency. So things are not that bad, and that was seen as a sign by the markets that the ECB is going to end QE, everything is getting better, and the euro strengthened. But later on, after that meeting at the middle of March, Draghi had more opportunities to talk, and they clarified that they only wanted to express their sentiment about removing tail risk. Only the most extreme cases are gone. So the danger of deflation, for example, is sort of non-existent. But it doesn't mean the situation is really good. There's still need for more accommodative policy, more stimulus, more QE, printing more euros, a weaker euro. We also had other speakers from the ECB basically going in all directions, some suggesting raising the interest rate, the deposit rate, before ending QE. But this was later denied. Maybe now I'll have more questions about that. So basically, what markets want to know is what's next. As we mentioned before, from April, from this month, the ECB is buying less bonds, less corporate, less government bonds, only 60 billion per month after 80 billion. The program runs until the end of the year, until December. As we've learned from this opening statement, they can, of course, extend it if needed, but that's a very generic thing, not new. And of course, we'll have questions about raising the deposit rate. Something that the economic background is that inflation back down in March. It fell to 1.5% from 2% on the headline and 0.7% on the core after reaching 1% after many months of steady core inflation at 0.8, 0.9. So Draghi's dovishness was vindicated, so it can be a bit more dovish, pushing the euro lower. On the other hand, the CPI numbers coming today, the preliminary numbers from Germany and from Spain, look already better. It seems that March, the lower inflation in March was just a one-off, was a blip. And GDP, growth in general, unemployment, things are looking better in the Eurozone. And something the ECB will probably not talk about really directly, but politics certainly play a big role. Because if the lady here on the right, Marine Le Pen, is elected, it's a huge existential danger for the ECB, for Mario Draghi's job. And of course, they hope for Macron to win, and Macron on the left here has higher chances, so they can be a bit more optimistic. So basically, we have the press conference beginning in 25 minutes. Again, no change in policy. We've already learned that. No new forecasts. That's a given. Questions to watch out for was when lower inflation in March just a one-off. If he says it's a one-off, it's good for the euro. If he says, well, we have to be cautious and worried, it's bad for the euro. Questions about growth. And he'll probably dodge questions about politics. And what does this mean for the euro? If he's optimistic, related to the French elections, to hopes for Macron or not, the euro, which is in an uptrend, as we've seen in the uptrend channel, extends the move to the upside. It has room there. If Draghi is cautious, I guess euro will wobble, stall, but eventually continue higher. And dovish Draghi, which we've seen in the past, we can still, well, it's one of the options now. I see it as a low probability option that Draghi will drag down the euro, seeing everything negative, the glass half empty, that there is still a long way to reach higher inflation, political uncertainty about the German elections, other things to worry about. There are always things to worry about. But in general, my bias and what I see in the chart is euro positive, is that the euro, even if it doesn't gain immediately after this press conference, the trend remains to the upside. So that's my ECB preview. We'll know everything in 20 minutes or so.
Yeah, so we can, according to you, we can expect any, well, it's an uptrend in the euro dollar, and no matter what happened today. Well, it matters if Draghi says something big, but overall, the uptrend will remain intact.
Yeah, Draghi in more cases than not is dovish, but I think that this time he will not be that dovish. He'll be balanced, if not a bit optimistic.
Okay, thank you. And then I know that Donald Trump provides some, well, he always provides news, headlines, but yesterday he decided, well, he was filtering about going out or into NAFTA, you know. Finally, at the night here in America, he said that the NAFTA, that the United States will or want to remain in NAFTA, in the NAFTA. So what do you think about that?
Well, I think it's something that is characteristic of the Trump administration. So far, a lot of confusion. They didn't fill all the cabinet posts. They're not professional enough so far. I'm sure they will improve because every new administration has issues at the beginning. I thought that threatening to leave NAFTA is part of the negotiation tactic, but that was probably something that Trump's aides told Politico, and then we had as you said, the president clarified that it's just a renegotiation, something that is not a surprise. And also Canada or Mexico are open for some kind of a renegotiation. It's a 20-year-old agreement. So far, there's been a gap between the big statements and reality. So I believe there's room for renegotiation. It's an agreement from the early 90s, before the internet age. Surely many things need to be updated there.
That's right.
So I think eventually it'll be, and I hope, a bit more calm than the big statements on the campaign trail. We've seen Trump saying that on day one he'll label China as a currency manipulator, and it's not on the agenda anymore. And he criticized Obama and Bush interventions in the Middle East, and he found himself bombing Syria and using the mother of all bombs in Afghanistan. So I think also with NAFTA, hopefully there will be some renegotiation. It'll be good for all three countries to update this agreement and not tear it apart.
Yeah, I remember. It's interesting that you mentioned that the White House have to learn how to speak to markets. I remember the first year of Obama when Timothy Garner, yeah? No.
Yeah, Geithner. Mm-hmm.
Yeah, he was talking about the China proposal to replace the dollar. He was, okay,
Right.
we are open to study that. And then when he said that, he was thinking, okay, the real thing, he was saying that, okay, we are open-minded, so we can explore any possibility, because everybody has the opportunity to explain their ideas. But the market was listening that, oh my goodness, Timothy Garner is just saying that the United States want to replace the dollar. Yeah, the China, the United States open, and then the market was the euro dollar was falling like a hell, like a 200 or 300 pips by that time in just one or 2 minutes. Do you remember that?
Yeah, I remember. Yeah, so
that's interesting that you made that case that they have to learn how to deal with markets. And okay, so NAFTA. And then move to the dollar, Canadian dollar.
Yeah.
Yesterday, they were trading in really highs and almost 1.3640 was the high. Then they get back to 1.3520 on the back of that news. What do you see there?
Yeah, well, Trump began picking a fight with Canada already earlier this week. He was talking about how Canadians outsmarted Americans in trade negotiations. He mentioned lumber, timber, softwood, and also dairy products, especially for farmers in Wisconsin. So that caused some triggers, the initial moves above 136, and then these comments that you mentioned about getting out of NAFTA, breaking up NAFTA, sent Canadian dollar higher, and then the denials sent it back to 135.20. Anyway, so I think Trump is a bit nervous, desperate to get some kind of achievements as the 100-day mark gets close. And this 100-day mark is something he said. He signed a contract with the American people on the campaign trail. Eventually, I think he'll be distracted by another story, and these things will calm down, and dollar Canadian will depend, as usual, on oil prices, and oil prices are falling. So I am a bit bearish of the Canadian dollar, but less because of Trump and more because of falling oil prices.
Do you see the Canadian dollar going to 1.40 in the near term?
It's possible, but it's moving a bit slowly. I don't think it'll be a fast move. I think it'll be sort of 2 steps forward, 1 step backward kind of movements like we've seen in recent weeks. And a lot more depends on oil. A lot depends on, here we are with oil prices. So OPEC can extend their production cuts, make a lot of statements, but basically production by OPEC countries, non-OPEC countries, and the United States is rising. And there's also this issue of housing in Ontario, especially something that was highlighted by Adam Button of Forex Live, that the Ontario government took some measures to curb the house price rises in Toronto and in other places in Ontario, and that could also have an impact. It comes on the heels of similar moves in British Columbia and Vancouver. So for those of you trading the Canadian dollar, the reasons, if you see a cool down in housing, it can eventually cool down the whole economy. Maybe it's better to cool the economy now, housing now, than have the bubble explode. But in any case, it's not, in the immediate term, it's also negative for the Canadian dollar as well as oil prices are.
In your opinion, what will make the dollar Canadian down below, down below 135, or even further down, even lower to 140? What will make that?
Well, if the Federal Reserve changes its mind, if we have a weak GDP tomorrow, following more negative figures from the United States, and the Fed goes dovish, no hike in June, then we'll see the US dollar falling and the Canadian dollar taking advantage of that. But I'm not sure it'll happen that fast, because if the US economy slows too much, it's also bad for the Canadian economy. So again, my bias remains a bit more to the upside on dollar CAD and against the Canadian dollar. So, but for the pair to fall, it depends more on the United States.
Okay, getting back to Trump again.
Yeah.
Sorry to be so repetitive, but you know Trump is in the headlines right now. Well, what is your opinion on tax reform? Don't you see the dollar? How can be the effect of the tax reform, the tax plan into the dollar? Do you see any downtrend in the dollar coming from the change that Donald Trump is expecting to introduce?
It's sort of a downtrend on the expectations. I mean, we had the move higher on Friday. We had some news that the Trump administration is going to introduce a new tax plan just before the 100-day mark on Wednesday. That Wednesday was yesterday, and it was a bit short on detail. We already heard from Republicans in Congress, which control Congress, that it's just the beginning. It's going to be negotiated. Anyway, it's going to be one-pager. So that hurt the dollar yesterday, that's for sure. We've seen the dollar fall across the board. No doubt about that. What's next? I think it'll take a long time. It's going to be, the story is going to accompany us for a few more months. And I think eventually we are going to see some kind of tax reform. Also, Democrats want some kind of change over there, but I don't think it's going to be that exciting for markets. This 15% corporate tax is not going to come very fast. So I think markets have learned, are a bit disillusioned with Trump. I mean, if something positive comes up, they're going to cheer and the dollar is going to rise, but the moves are much more cautious. The huge excitement that we've seen in November and December, I think we will not see that again anytime soon.
Well, we got a question here in the YouTube channel. Mohammed Fasil say, like, if he understand good, the tax rate cut means consumption of goods increase. That's mean price of the goods increase. increase, that means more imports. So the value of the US dollar will go up. What do you think about that?
Well, American consumers consume a lot of goods from China.
Yeah.
And it may Chinese cheap goods help the U.S. economy eventually. I mean, help U.S. consumers. If we'll have lower tax rates, one of the things in the program is that there's going to be some kind of a one-off repatriation opportunity for companies to repatriate their money from abroad and to pay very low tax and move it back to the United States. So if we do have this kind of component in the plan, that'll of course help the dollar in the immediate term, because money will just flow to the United States from the big companies, most of them tech companies such as Google, Apple, Facebook, that hold money abroad. But the devil is in the details. There was lots of talk about this BAT, border adjustment tax. This should also help the dollar, but it's unclear that this will ever happen. And the most important thing, I think, for the US dollar in the longer term is if it's a tax plan that helps growth, and it's possible that we get that along the road, and that'll help the US dollar. But if it's just a tax plan, as some critics say, that helps only the very rich, then it won't ignite more consumption, and it will not help the US dollar. So we had this one page yesterday from the Trump administration, from Gary Cohn and Steve Mnuchin, and that's just the beginning. So I think it'll take 3, 4, 5, 6 months until we get some kind of legislation.
Don't you see this is like a dangerous cocktail that can spur inflation going beyond the Federal Reserve target, and it could finally turn into a recession in the long term? You know, if you have a upward or inflation rising so quickly, so the Federal Reserve will have to hike rates quickly, and then it will have an impact, and a negative impact in the economy.
That was the expectation at the beginning, just after Trump was elected. So the expectation was he had huge promises about infrastructure, $1 trillion to repair roads, airports, ports, all good ideas, I think, and that is going to lower taxes. So more consumption, more government spending, higher deficit, higher inflation, higher dollar, sort of another boom and then a bust, as you described very well. But again, it depends on the details. So far, we haven't seen any serious infrastructure plan. This tax program is just a one-pager. That's what they produced after 100 days in government and 70 days in transition beforehand.
Mm-hmm.
So we'll have to see the details, I think. I thought we had a chance for a stronger dollar on the back of these expectations, and even euro-dollar parity in January, before things really got into motion. But Trump already began disappointing, I would say, or sort of cooling things down already in his big press conference at the beginning of January. We missed that opportunity. With every day that passes, we're seeing, so far, things might change, but so far, an administration which is not really capable of moving things. We've seen that with the healthcare reform that failed spectacularly. So in theory, if Trump pushes things forward, what he promised in the campaign, we'll see huge growth, huge inflation, and then a bust. But things are moving slowly.
What huge?
Huge, yeah. Tremendous.
Tremendous, yeah. Yeah, that's I agree with you. You know, there is no Obamacare replacement. There is no wall. You know, no wall. There is no a real tax reform, just a one page. No infrastructure. You know, and no out of NAFTA, no out of the Pacific, the Trans-Pacific Agreement, and they have taken. Well, you know, the world was really concerned about Donald Trump administration the first day. Okay, it will be a mess. It will be a real impact, but the days come, and the impact hasn't been that real impact and especially in the economy. Well, the only thing that we can see is a uptrend a rally in the stocks. and it could be backed by inflation expectation before.
Yeah, but if we don't have strong growth, we'll not have a big rally in stocks. What I have seen is that there is some damage to tourism in the United States. Less people are coming, so that's a negative impact of Trump. But I think it's such a minor part of the U.S. economy that will not have a big impact on the U.S. dollar and on the Fed. So far, it's sort of the economy is going on as it was before. So
and there is slow growth. And there is interesting that you say about the tourism. Everybody, that has come to visit me here, my friends or my family. I'm from Colombia, and also I have friends everywhere. I used to live in Spain and Japan. There, I have many friends coming here to Florida and visiting me, and they were afraid of how U.S. custom. They are always rude. Okay, papers. Okay, who are you? Okay, what are you going to do here? It's very straight and very. The manners are not that good, and that because you have come here several times.
Not so pleasant.
Yeah, but in the last month, all my friends and my family are telling me that that's a very pleasant time. I was expecting, more rudeness, but they are telling me that the custom performance are more friendly, and they are, I think this is like the opposite way, just to make people clear that okay, Donald Trump is here, Donald Trump is our president, but we are above a society about that.
Okay.
Okay, there are a question here about the pound, the cable, pound dollar.
Sure.
What are your thoughts on pound dollar?
Levels? Sure. Let me open the chart. So pound dollar currently 128.93. I still see the 129.05 level. Where did that line go? Yeah. Or 129. That was the initial swing high after the announcement of the UK elections. We had a break above this level this morning. I see that as a false break at the moment. So that's immediate resistance for me. Further resistance, the round number of 130, more psychological than technical. Further resistance, 130.50. That's already a level that belongs to, that was the high here back in September, if I'm not mistaken. I have this annoying thing here. So, September. Yeah, and above that, 130.130. So these are the levels of the upside. On the downside, I still look at 127.90, even though it has been broken. And 127 is much stronger support. 127 was a high level back at the beginning of February. It's followed by 126.15, a high level in March. So these are the levels I'm looking at on the pound. Again, fundamentals moving the pound. On one hand, optimism for soft Brexit after the elections, after Theresa May gets her full mandate. She was never elected, to remind you. She inherited the government from David Cameron and was not really challenged in her own party. On the other hand, the UK economy is slowing down. We'll learn more about that tomorrow. So that could hurt the pound. So these are the two forces that are moving the pound. The most recent rally, this false break, as I mentioned, above 129.15, is fueled by the weakness of the US dollar following Trump, less by anything related to the pound.
Okay, so we are just 4 minutes away. I'm sorry for change of topic so abruptly, but we are 3 minutes to go with Mario Draghi, the press conference. And just to remind people that we are showing, we will show the presser here, and we will have Mario Draghi with us. And after that, we will make some remarks and some thoughts on what you as trader can expect from what Draghi said in the press conference. So meanwhile, I am preparing the stuff, preparing everything to have Mario Draghi with us here. Can you see us what we can expect and what we can expect, how can that affect the market?
Yeah, so bottom line for the ECB press conference is the tone of Mario Draghi. Is he optimistic? It can be related to the prospects of having Macron as the president of the French Republic. On rising inflation, we had fresh figures from Germany. Came out year-over-year inflation at 2% above 1.9 expected. Also better than expected inflation from Spain. And I expect Draghi not to be dovish this time, and the euro-dollar to extend its trend in uptrend channel. Higher highs, higher lows. Another scenario also realistic is a cautious Draghi. The euro more balanced, seeing also negative things such as, well, inflation is still far from the 2% or a bit below target, things like that. And the euro sort of wobbles, stalls, but in the long run continues higher. And this time I see lower chances of Draghi dragging down the euro. He did that in the past so many times. But this time, a bit of a higher inflation, a bit of optimism I guess he'll sort of see the glass half full this time. And as we await Draghi, I'll also mention that we have lots of US figures released at the same time. Durable goods orders, most important one for the month of March. This feeds into the GDP figure that we get tomorrow. And also jobless claims, inventories, things like that. Currently, we have euro-dollar at 108.90. For me, this is bang in the middle of the range that we've seen since the French election, since the first round. 108.30, strong support. 109.50, strong resistance. 60 pips to the upside, 60 pips to the downside. So it all depends on Mario Draghi. Maybe depends also on durable goods orders, but for the euro, the focus is the ECB president. Yeah, ready to go?
Yeah, we are waiting for Mario Draghi, Mr. Mario Draghi, Mr. Confetti, Mario Confetti Draghi.
Yeah. Here's a picture from
Yeah, I see.
That event. Anyway, in the meantime, we had the figures. Sorry?
It was an advice, an early note about the European sentiment, on the anti-European sentiment, about the anti-ECB, that girl sending, pushing confetti to Mario Draghi, and then 1 year after or 2 years after, we got Marine Le Pen running for president in the same anti-European sentiment,
Yeah.
Interesting.
Yeah, it was fueled by Brexit as well. And
yeah, that's right. Okay, we are waiting for Mario Draghi. He's 1 minute late.
Yeah, all the usual jokes about him being Italian and. Yeah, we're waiting for Draghi.
Okay, we are ready here.
Yeah.
Okay. Well, what was the results? You know, you were, well, here he comes. I was about to talk about the economic data that just came out with worse than expected initial jobless claims. Okay, here he is.
Yeah, journalists taking over. So Eurodollar 108.90. Just before he begins talking, let's see where it ends afterwards.
Blue tie.
Yeah, don't know what it means, but maybe someone knows. Okay, let's hear him. I'll drop a few comments in his pauses.
Ladies and gentlemen, the Vice President and I are very pleased to welcome you to our press conference. We'll now report on the outcome of today's meeting of the Governing Council, which was also attended by the Commission Vice President, Mr. Dombrovskis. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. We continue to expect them to remain at present or lower levels for an extended period of time, and well past the horizon of our net asset purchases. Regarding non-standard monetary policy measures, we confirm that our net asset purchases at the new monthly pace of 60 billion euros are intended to run until the end of December 2017 or beyond if necessary, and in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with its inflation aim. The net purchases will be made alongside reinvestments of the principal payments from maturing securities purchased under the asset purchase program. Our monetary policy measures have continued to preserve the very favorable financing conditions that are necessary to secure a sustained convergence of inflation rates towards levels below but close to 2% over the medium term. Incoming data since our meeting in early March confirm that the cyclical recovery of the euro area economy is becoming increasingly solid and that downside risks have further diminished. At the same time, underlying inflation pressures continue to remain subdued and have yet to show a convincing upward trend. Moreover, the ongoing volatility in headline inflation underlines the need to look through transient developments in HICP inflation, which have no implication for the medium-term outlook for price stability. A very substantial degree of monetary accommodation is still needed for underlying inflation pressures to build up and support headline inflation in the medium term. If the outlook becomes less favorable, or if financial conditions become inconsistent with further progress towards a sustained adjustment in the path of inflation, we stand ready to increase our asset purchase program in terms of size and/or duration. Let me now explain our assessment in greater detail, starting with the economic analysis. Euro area real GDP increased by 0.5% quarter on quarter in the fourth quarter of 2016, following a growth rate of 0.4% in the third quarter. Incoming data, notably survey results, bolster our confidence that the ongoing economic expansion will continue to firm and broaden. The pass-through of our monetary policy measures is supporting domestic demand and facilitates the ongoing deleveraging process. The recovery in investment continues to benefit from very favorable financing conditions and improvements in corporate profitability. Employment gains, which are also benefiting from past labor market reforms, are supporting real disposable income and private consumption. Moreover, the signs of a stronger global recovery and increasing global trade suggest that foreign demand should increasingly add to the overall resilience of the economic expansion in the euro area. However, economic growth continues to be dampened by a sluggish pace of implementation of structural reforms, in particular in product markets, and by remaining balance sheet adjustment needs in a number of sectors. The risks surrounding the euro area growth outlook, while moving towards a more balanced configuration, are still tilted to the downside and related predominantly to global factors. Headline inflation has been recovering from the very low levels seen in 2016, largely owing to higher energy price increases. After reaching 2% in February 2017, euro area annual HICP inflation stood at 1.5% in March. This reflected mainly lower energy and unprocessed food price inflation, but also a decline in services price inflation. Looking ahead, on the basis of current futures price for oil, headline inflation is likely to increase in April and thereafter to hover around current levels until the end of this year. However, as unutilized resources are still weighing on domestic wage and price formation, measures of underlying inflation remain low and are expected to rise only gradually over the medium term, supported by our monetary policy measures, the expected continuing economic recovery, and the corresponding gradual absorption of slack. Turning to the monetary analysis, broad money M3 continues to expand at a robust pace, with an annual rate of growth of 4.7% in February 2017, after 4.8% in January. As in previous months, annual growth in M3 was mainly supported by its most liquid components, with a narrow monetary aggregate M1 expanding at an annual rate of 8.4% in February 2017, unchanged from the previous month. The recovery in loan growth to the private sector, observed since the beginning of 2014, is proceeding. The annual growth rate of loans to non-financial corporations declined to 2% in February 2017 from 2.3% in the previous month, while the annual growth rate of loans to households remained broadly stable at 2.3% in February. At the same time, the Euro Area Bank Lending Survey for the first quarter of 2017 indicates that the net loan demand has increased and bank lending conditions have further eased across all loan categories. The pass-through of the monetary policy measures put in place since June 2014 continues to significantly support borrowing conditions for firms and households and credit flows across the euro area. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed the need for a continued, very substantial degree of monetary accommodation to secure a sustained return of inflation rates towards levels that are below but close to 2% without undue delay. In order to reap the full benefits from our monetary policy measures, other policy areas must contribute much more decisively to strengthening economic growth. The implementation of structural reforms needs to be substantially stepped up to increase resilience, reduce structural unemployment, and boost productivity and potential output growth. Regarding fiscal policies, all countries should intensify efforts towards achieving a more growth-friendly composition of public finances. A full and consistent implementation of the Stability and Growth Pact and of the macroeconomic imbalances procedure over time and across countries remains crucial to enhance the resilience of the euro area economy. And we are now at your disposal for questions.
Mostly bullish, euro dollar up 40 pips.
Jones, Financial Times. Thank you.
Yeah, bullish.
Mr. Draghi, was there any support today from members of the council to say that the risks to the outlook were now balanced rather than to the downside, or was that a majority view? And should Emmanuel Macron's secure victory on May the 7th,
Question on politics.
would you then regard the risks to the economic outlook as balanced? Thank you.
Thank you. Well, the answer to the second question first. We actually don't do monetary policy based on likely election outcomes. But on the first question, we actually had a discussion on the balance of risks as far as growth is concerned, not inflation. That's an important distinction that I want to mark. And some of the members had a more, I would say, sanguine view of the economic situation, and others, while acknowledging that there have been improvements, on which I will say a few words later on in the growth outlook, believed that such improvements would not warrant any change in communication as far as the balance of risks are concerned. In the end, the Governing Council agreed about this language that basically says that the one I've read before, that says the risks surrounding the euro area growth outlook while moving towards a more balanced configuration are still tilted to the downside and relate predominantly to global factors. You remember that in the previous formulation, we only said they remain tilted on the downside. So the Governing Council agreed about this, and I should say all members of the Governing Council agreed about this formulation, so we can actually speak of unanimity in this.
Unanimity, they found a compromise, yeah.
Yeah.
But slightly less dovish than, less downside risk.
Let me also add that as far as inflation or risk to inflation outlook, there weren't really different views. The behavior of inflation as it stands was basically shared by everybody.
Thank you, Andreas Ramke from Reuters in Frankfurt. Let me follow up on the inflation you mentioned in January. I think you gave us 4 criteria for the inflation that are needed or that become better over the course of the time. I would be interested in your assessment on this 4 criteria. And my second question, very German thing, Mr. Schäuble was very, very critical in Washington at the IMF meeting about your monetary policy, calling it not helpful. What is your reaction on this?
As I said at the time, we don't comment politicians' statements about our monetary policy.
Not really true.
Only to say that it's pretty ironic to hear these comments from people who supported independence of monetary policy, independence of central bank all throughout. Let me now say something about inflation. Headline inflation declined stronger than expected in March reflecting lower inflation rates for all main components. And underlying inflation remains subdued. The short-term outlook was revised down due to lower oil prices and a weaker starting point for underlying inflation. Indicators of pipeline pressures show tentative signs of build-up of producer prices and upward pressure at the early stages of the pricing chain. Wage growth has been picking up slightly from a very subdued level, yet the outlook for wage growth remains uncertain. So market-based expectations, well, we can talk about market-based expectations. So in terms of my criteria, the assessment hasn't really changed. The criteria are basically that the inflation path should converge towards our aim of an inflation rate of below but close to 2%. It should be a durable convergence, so not essentially produced by transient factors like we've seen in the headline inflation recently. It should be, very importantly, it should be self-sustained. The present inflation path is predicated on maintaining the strong monetary accommodation in place, and so the self-sustained means that it will stay there even without such strong monetary accommodation on our side. And of course, the inflation we talk about has to relate to the whole of the Eurozone and not to one country only.
Mr. Ferris?
Thank you. Tom Ferris from the Wall Street Journal. My first question was on the sequencing of the exit when it comes from the QE. In your statement, you reiterated the forward guidance, but at the last meeting, you seemed to suggest there was some room for flexibility there. My question was, is there any likelihood of a change, and is there kind of a grey area where the interest rates could be raised before the end of the net asset purchases, but after the QE has started to be wound down? My second question was on the, more generally, it's 6 years since the ECB raised interest rates just ahead of the Eurozone crisis, a decision that was subsequently criticised. In that case, you were focusing very closely on inflation, and you seem to miss, or subsequently criticised for missing the broader economic situation. Today, you're once again very focused on inflation, and even as the economy picks up, how much of a risk is there that a similar policy mistake could be repeated? Thanks.
Here comes the beer
I'm not sure I get the
squeeze.
logic of the second question, but I'll try to answer that anyway. Now, first of all, on the first question, the sequencing, I don't think there's any need to discuss this now. We have not seen any evidence or any sufficient evidence to alter our assessment about the inflation outlook. And we are not sufficiently confident that inflation will converge to levels consistent with our inflation aim in a durable and self-sustaining manner.
Confident.
So from today's standpoint, there is no reason to deviate from the indications we have been consistently providing in the introductory statement to this press conference. But let me also just repeat what I said in the speech at the ECB Watchers Conference. The Governing Council deems the current stance fully appropriate. It confirmed at its last meeting that net asset purchases will continue until the end of December 2017 or beyond. This implies that our various policy instruments are deliberately chained together in such a way that the forward guidance applied to our asset purchase program, which is time and state dependent, extends also to our interest rate policy. So our forward guidance is de facto on the entire package, not on any specific component of it. And this guidance relates not just to the conditions under which we would withdraw stimulus, i.e. the sustained adjustment in the path of inflation, but also to the sequence of measures we would use to do so. So from today's perspective, the negative rates in conjunction with the other elements of our easing package have turned out to be powerful in terms of easing financial conditions, and the potential negative side effects have so far been limited. We can discuss this later. So the current wording of our forward guidance reflects exactly this assessment of side effects. And from today's standpoint, I don't see cause to deviate from the indications we've been consistently providing in the introductory statement. Now, the second question, the logic of which, yes, is the, if I can rephrase it, is the experience of we had in 2011 going to be repeated today? Actually, I think it's the other way around. In 2011, we forget, but we actually had a high rate of inflation for several months, above 2%. So that was the situation. We are now not having a high rate of inflation above 2%. We actually have a very subdued underlying inflation rate and volatile headline inflation led by a development in oil prices and unprocessed food prices. So the situation is different.
Okay, Yohay, so in your opinion, it was a bullish or not that dovish statement from Mr. Draghi?
The statement was generally bullish. Two significant things that Mario Draghi said in the press conference. First, we had them talking, well, the language about downside risks has changed. Only a small change. They still see more downside risks than balanced, but they did give a nod to the improving economic situation, stronger growth. That means that the chances of downside risks have somewhat diminished. Solid growth, economic recovery, all are positive things. We've seen euro-dollar on the statement move from the bounce point of 108.90 all the way to 109.32. But then in a question to an answer, an answer to a question, Draghi did say that he doesn't, that he's not confident enough that inflation is going to reach the target. That when he was asked also about the exit strategy, he said it's a bit too early to discuss the sequencing of of how to exit policy. That means, okay, sort of you managed to balance between things are improving, less downside risks, but we're still a bit far from exiting, from moving to ending QE. And I think that's why we've seen euro-dollar backtrack all the way to 108.90. Now we have another 30 minutes of press conference. I don't think he's going to say anything new, but what we're seeing so far is closer to my second scenario of sort of manages to balance caution with optimism. For me, the what he said at the beginning has it has greater weight. I see euro-dollar eventually continuing the uptrend, more optimism than dovishness. Less dovish Draghi, much more optimism driving the euro higher. So currently we're just totally balanced since the beginning of the press conference. I believe that eventually we'll see euro-dollar moving up either a few hours after the press conference or in the next week. Of course, specifically on euro-dollar, not only the euro, a lot depends on the US GDP tomorrow.
Don't you feel that journalists were more dovish than Draghi himself?
Yeah.
Well, like, okay, but let's talk for real, you know? What happened? What's going on real?
Yeah, they were a bit, because Draghi is more, he belongs to the dovish camp, and there are a few German central bankers there and others that are more hawkish, so they wanted to put him on the spot. Okay, you personally, Draghi, Mario Draghi, the president, what do you really think? They're probably a bit more dovish, a bit more cautious in inflation, and I think they did get that out of him, and he did say that some other members were a bit more sanguine about the outlook, so that's what hurt the euro. He was also asked a political question about Emmanuel Macron, and he dodged that, of course. He was smart enough to do that. And he was asked about Schäuble's comments, and he said, on one hand, we don't comment on what politicians say. On the other hand, don't interfere in our business. So it is a comment on what he said. Anyway, he's a bit more dovish than the others, but all in all, he does need to acknowledge reality. The economic situation is improving, not only in the Eurozone, but elsewhere. So I believe we've seen euro-dollar move 40 pips to the upside, backtrack all the way. In general, I see euro-dollar continuing its gradual trend in the channel to the upside.
Okay, let's make a quick market commentary. Euro-dollar, as you say, was testing highs, and 1.0920, I guess. But right now, the British pound is also testing highs.
Yeah, let me share the screen.
Yeah, and the Australian dollar is going down.
Yeah.
What is your take in the British pound?
Well, there was nothing pound related in today in general or in the press conference, of course. What we're seeing is more of a dollar weakness. Just before Draghi began speaking at 12:30 GMT, we had the release of some US figures. They were worse than expected. Durable goods orders missed expectations, rose only by 0.7 on the headline instead of rising 1.2, dropped on the core 0.2 instead of rising 0.4. There were some upwards revisions, but all in all, it's a disappointment. Jobless claims are up 257. We aren't seeing huge moves, but what this move up again in pound dollar, I think it's fully related to the disappointment in US figures.
Okay, thank you, Yohay. And just to finish, in your opinion, what traders should focus now? Which pair? I know that tomorrow we will have the GDP of the United States, but right now, coming before, in the next hour before GDP release, but what are the best pairs to trade and the best pairs to focus for the traders?
Well, I think it's still a euro dollar and pound dollar that we've talked about because we'll have more echoes to what Draghi said, more analysis coming in the next few hours. Then tomorrow we have the all-European inflation figures at 9 GMT, if I'm not mistaken. Yes, 9 GMT. And before that, we have the UK GDP, the first release, and the first time that we're expecting some kind of a downfall after Brexit. So official expectations stand at 0.4% quarterly growth instead of 0.6. I believe it could be worse. Well, we really don't know. So the pound dollar will certainly be interesting, especially as it hovers around the highs. And then euro dollar for the next moves with the US GDP, but also around the US GDP, perhaps the best mover will be dollar yen. Dollar yen often best reflects the general mood about the US dollar.
Okay, thank you, Yohay. So I think we can wrap up now after these comments. See you tomorrow. Thank you for coming today, and thank you for everybody.
Thank you.
And see you tomorrow for the GDP, right?
Yeah, it's going to be exciting. It's the first release, always the most important one. We'll have also Valeria back, and I'll have a good show. Yeah,
we should ask her for some Japanese words, like a sumimasen, like arigato, something like that. Okay,
right.
Yohay, thank you very much, and thank you everybody for coming today. See you tomorrow. GDP, the United States, at 8 o'clock in the morning in America, but this is 12 GMT, I guess, right?
Right, exactly.
Okay, so thank you, Yohay. Bye-bye.
Thank you. Bye-bye.
Okay, guys, see you tomorrow for the next live coverage with Yohay Elam, myself, Mauricio Carrillo, and we will have Valeria Bednarik with her, always bright and smart comments on pairs here. Trade safely, place the stops. Always stops, loss stops, and take a profit. Bye-bye.